Hello. Today I want to talk about some things to not do before your mortgage closing. Again, things you should not be doing before your mortgage closing. So, the first thing is number one, do not make large purchases. Avoid buying cars, furniture, expensive items such as this could affect your debt to income ratio and will affect your debt to income ratio in 99% of the instances. So, what we mean by avoiding buying furniture and cars, I got this, it's not going to be on my report. You'll go to a lot of furniture places. You don't have a payment until 2025. You won't have a payment until 2029. We will still see that on your report. We do what's called a soft pull right before closing. If they see that you have that inquiry, you will have to you explain what that inquiry was, and if you purchase something, and then get us a copy of the agreement, and that will be added to your debt to income ratio. The same thing for co-signing for people, or getting products. I want to get a new security system, or I wanted to buy this new TV and a washer and dryer set. I'm not going to get it until I close, but you already did the application, and we already saw that you got it pulled by the department store, wherever you're getting it, and it's being delivered. That debt would have to go on your application and could negatively impact your loan approval. Secondly, do not apply for any new credit. Any new credit inquiries on your account can lower your credit score and also affect your loan approval. If you have too many credit inquiries, or we see too many things you said that you didn't get credit for, you applied for it and you did it, they could pull a new credit report. It could lower your score and affect your loan approval negatively. Don't miss any payments. Later missed payments on credit cards and loans and other bills will hurt your credit score. So just because you got pre-approved this month and you're like, oh, I'm not going to close for another 2 or 3 months, my credit report is good, you still don't need to miss any payments on credit cards, loans, or anything else. If you have something that pops up, like an old collection, you're like, hey, this is going to be on my report, you do want to settle that so that it doesn't go on your collection or work out, on your credit report, or work out something so that does not affect your credit score. Most of the time, your credit score on conventional loans is good for 90 days. On VA, FHA, USDA, a lot of times it's good for 120 days, but they still will, again, do that soft pull and make sure no new debts have popped up. And that includes new collections. The next one in this market is do not change jobs. A lot of people are changing jobs. They'll go from self-employed to W-2 or salaried, or vice versa, which is worse, to go from W-2 to a self-employed. But changing jobs could even delay or jeopardize your loan approval, especially as it alters your income structure. And what I mean by altering your income structure is you were getting paid a salary plus bonuses and commissions. Now you went to a new job. Yeah, it's still W-2, but you're straight salary. And maybe a good part of your income was those bonuses and overtime and commission. We don't have an example of overtime on the new job, so we can only go off your base pay. And maybe that was a good 20% of your income was overtime. Now you've lost that and you don't qualify for as much as you did before. Another thing, do not make large deposits or transfers into your bank accounts. Making large deposits or transfers into your accounts, unexplained large deposits or transfers can trigger additional scrutiny on your loan. So if you move money, be prepared to document the source, whether it's a gift, you sold something, or anything like. What we're trying to do is to make sure you didn't get a new loan and get any new debt. If you sold something, you want to make sure you have a bill of sale and make sure that you can actually provide proof that you sold something, like a title that was on a car or boat or anything like that, and provide that. So if you do those large deposits or transfers, you will have to show that. And if you transfer from another account that we don't already have, or the bank doesn't already have, you will have to show that account, probably up to 60 days of that, to see, to see where those funds are coming from. Do not co-sign for any loans. Do not co-sign for anyone on a car or apartment or anything else while you're in the loan process. And it's probably not a good advice to do in the first place, but sometimes you have to do what you have to do. But co-signing increases your financial obligations, could affect your loan approval. Just because you co-sign and they're like, oh, I'm paying the payment, is coming out of my account, it's still on your credit report and it's still one of your debts. So even sometimes you can get that. When I say sometimes, I mean rarely, you can get that omitted by the underwriter, but that's going to have to be at least after 12 months of good payment history, and you would need proof that the person you co-sign for, whether it's your kid, parents, cousin, friend, anyone, that they've paid that out of an account that you're not attached to. You can't be attached to the account that they're paying that bill out of that you co-sign for, otherwise it will definitely be counted against you, against your debt to income ratio. Do not close any credit accounts. A lot of people are like, okay, I'm not using this credit card, I've paid it off, I don't need it open. Do not close your credit accounts. This shortens the amount of credit history that you have. Now you don't have that optimal credit. You don't have available credit. So that's part of your credit score. That's a whole nother thing. But do not close any credit accounts. If you have to pay off something at closing, talk to us. Let us know, like, hey, this is something you'll pay off at closing. But if you have it open, leave it open. Even if it's a zero amount on it, leave it open. You need to leave those trade lines open. Banks like to see open trade lines. And if you close a trade line, guess what? You have no history on that trade line. It's a closed trade line. So don't close your accounts. Do not ignore lender requests. A lot of times you'll get a lot of emails from your lender. I know our system sends some out. Some will come from me. Some will come from the processor, your transition coordinator, title company. Do not ignore lender or title requests. Respond promptly to any requests for documents or information to prevent delays. Your realtor will tell you this a lot of times. If you go past the contract close date, then you can be charged per diem, and that's something you don't want to get to. Per diem is they can charge you anywhere from $50 to $500 a day, depending on the price of the home and everything that you're buying. But do not ignore lender requests. If we ask for something, please send it to us, or if you don't understand it, give us a call. Let us know, and we'll explain it to you so you can get it over to us promptly. Do not spend your savings. I get a lot of clients that get 100% financing. Literally, what 100% financing means is that you got approved for 100% of the purchase price. Buying a home is kind of like buying a car, but just on a longer term. You still have tax, title, and license. So because you got approved for $400,000 and we got you a loan for $400,000, you still have your title with your escrows and all that stuff, your homeowner's insurance, and the homeowners association dues and other things that are associated with purchasing the home. So you want to leave your savings in there. Also, your savings show as reserves. Banks, we like to see that you have reserves left over after closing, so that we know that you can pay the mortgage in case something, God forbid, you lose your job or got to get a new transmission, that you still have money to pay your mortgage and get these things done. So usually reserves, sometimes you may need as little as 1 month, depending on the type of loan that you have. If you're doing a self-employed specialty loan, they may want 12 months, 6 to 12 months. So, and then if you own multiple properties, they could want, 2 to 3 months per property, up to 6 months per property. So do not spend your savings, whether that's your checking and savings account, whether that's your 401k, IRAs. Do not spend your savings. Lastly, do not switch banks. Do not switch banks during the loan process. This makes it difficult because a lot of times some banks, you cannot get a new statement until you've been in their system for 31 days. If you switch banks today and you're closing on the 19th, and today's the 19th, you won't have a statement by that time, and you do have to have a full bank statement, up to 60 months of your bank statements for to close on your loan. So do not switch banks through the process. Confuses a lot of things. It just makes it a lot more work. You can go in and get printed off reports and everything, but again, you're kind of making it harder for yourself. If it's something you can avoid, then avoid that. Just avoiding these common pitfalls will ensure that you have a smoother closing and reduce the risk of issues with your mortgage loans. If you had any other questions, give me a call. Hope this helped. Have a great day.